Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into the discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. And as ever, if you have any questions for our Bondcasters, please email them to us at bondcast@natwest.com. All right then, guys, we've got a lot to catch up on, or at least since I last did a Bondcast. I think I was saying to Giles yesterday that I can't believe we waited months for rates to break out of the tiny ranges that they were trading in, and I go on holiday for 2 weeks and bonds move 30 basis points. But there we go. I'm sure there's still more fun to be had for the rest of the year. So let's get straight into the discussion. I'll start with you this week, Theo, because I think, certainly on the inflation side, the UK has been, the biggest mover over the past couple of days, and that's certainly where the big story has been that's been driving global markets. So perhaps you can just give us an update on what's really been going on there and what you're thinking about that.
I think, first of all, we need to look at the main driver of that upside in inflation, and this is really commodity prices, in particular natural gas and electricity as well. In the UK, around 40% of the electricity is produced through natural gas, so it is very, very relevant. Now, in the UK specifically, because of supply disruptions, you have natural gas prices that have appreciated a lot more than in other markets. To put things into context, in the US over the last 3 months, natural gas prices appreciated by around 60%, but in the UK, they appreciated by around 160%. So the magnitude is totally different. So what does it mean for the market? We talk about a market that needs to price it in. We talk about substantially flatter RPI curves, a lot of buying at the front of the curve, a lot of widening. It is obviously marked relative to commodities, but also what becomes more difficult is to estimate the second order effects. So it's not just that higher natural gas prices lead to a higher part in the RPI basket that is higher, but also they've got broader implications. And this is, I think, the trickier part, the one that most investors are puzzled with. In any case, what we do expect is volatility in the inflation market to be particularly high because of that commodity-driven uncertainty. But also, we think that if once we see that commodity spike normalize a little bit, then obviously we talk about a steeper RPI curve, but also we talk a bit about more stable conditions. But this may be a story for another Bondcast, not right now.
Sounds like we could go into quite a lot of detail in that one. So without doing that then, how has the curve reacted to this kind of news and the latest stories?
Yeah, so the interesting part is that the market has reacted with a steeper curve, and we've seen steeper conventional curve, not an RPI curve, has reacted with steeper curve. We've seen that at the same time. What we find particularly interesting is, that the front of the curve has also moved higher. And to be fair, you can make the argument that higher inflation probably will create a big impetus for the BOE to tighten. However, we do think, and actually this week's comment from Governor Bailey show that the Bank of England, they understand that if it is a commodity-led pickup in inflation, that this is not necessarily asking for immediate tightening. So in our view, there is value at the front of the SONIA curve. We think that rates there are high. The volatility that we got this week and a bit of a sell-off that we got, especially on Tuesday, we think that that's an opportunity for investors to be involved. And we think that if we were to choose between the front and the back end, we think that there is more value just at the front, because the back end may have to reprice lots of different things, and may have to reprice changes in supply. It may have to reprice, for example, maybe structurally or higher inflation for longer. But in our view, the fact that we had natural gas prices or lack of HGV drivers or all that disruption, that doesn't necessarily mean that the Bank of England is going to tighten more anytime soon.
So what about thinking about nominals then? Because one of the the big kind of headlines earlier this week was that 10-year gilts had risen above 1% for the first time since the pandemic began. Now, avid listeners and readers of your notes will know that 1% target in 10-year gilts has that has been your target for some time, really. So how are you thinking about gilt yields from here then? Do you still think there's further to go, or are you looking at pulling back on some of those shorts now that they have reached that 1% target?
Yeah, I guess to be perfectly fair, the headlines are making it a bit easier for us. What has happened is there's been also a benchmark change. So in reality, if somebody was really to be picking into the details, they would figure out that that benchmark change makes yields look a little bit higher. In any case, there's been a considerable rise in yields, and yes, thank you. I mean, it's the 1% has been our target. We did not expect it to be reached right after the meeting, so we expected it to happen in a slower fashion. But again, I mean, it's you cannot predict exactly how markets will evolve. Now, thinking forward, we are looking at the market that can be a bit more of a sell-off potentially. But again, any sell-off, we think there's going to be limited. So the UK market has performed weak, and the UK market has priced in a lot of policy tightening already. But the UK market will probably have to price in a reduction in issuance that will come at the end of October. So this is something that we expect to be announced with the budget. So in terms of direction for 10-year yields, we think that yes, it can be, call it a 10 basis point more, 10, 15 basis points of a sell-off, but we think that the main sell-off has already happened. So probably we'll look at, if it goes the other way, probably to fade it and go the other way around. But the area where we think that is a lot more juice is really the front end, because if for whatever reason the political landscape and the economic landscape deteriorates, then we talk about a lot of buying at the front end of the curve, which is very, very which is very high. The other thing that we need to say is obviously that the linkage between markets is very strong, and obviously a lot in the UK will happen depending on what we get in the US and the euro area.
Which was a very nice segue into the euro area there. So Giles, over to you, because European rates have participated fully in this sell-off as well. Is this just being driven by repricing of inflation expectations, just in the UK, or is there something else going on that you think is driving rates higher?
I think most of the factors that Theo has been talking about also apply to the euro area, to be honest with you. Perhaps in a slightly less spectacular way, but I think that the ingredients are all there. Now, listen, I think I'd actually push back a little bit on this idea that Europe has fully participated. Actually, I think that it hasn't participated as much as I would have liked, or I would have perhaps expected. And I do think, again, I mean, this is it's a bit of an ongoing theme this year. I think that expectations about where European rates should be are just too heavily weighed down by the experience of recent years. And I think that inflation expectations coming back in the way that they are, even if we are still base case talking about transitory inflation, which I think most people are, that's still a pretty big difference to kind of 18 months ago, where there was no inflation of any kind, transitory or not, to be honest with you. And now, even compared to just 3 or 6 months ago, when people started spotting some upside risks to inflation, and then there was this whole debate about, is it transitory, is it not? Well, you list all the reasons that you think inflation is on the high side at the moment. Individually, they all look pretty transitory, but they start piling up in a way where you're looking at much higher inflation than you thought was likely, and quite it's going to be more higher for a more extended period than you thought was likely, and that does clearly increase risks, particularly when we've just seen in today's data again. I mean, Spanish inflation massively overshot again on energy prices, but that's going to be sustained for a while. And the backdrop, the macro backdrop we saw from the Commission surveys is still very robust. So I think that this idea that there is no inflation and will never be any inflation in Europe is something that we perhaps need to start reconsidering in a bigger way. So, and there you go, a call to arms.
Well, I think you've answered, or listeners should hopefully be able to infer from what you've been saying, the answer to my next question, but I'm just going to ask it anyway to give you the opportunity to spell it out. But that's, so we think that there's further to go then in this sell-off for European rates, and if so, how much further? What kind of level in, say, 10-year bunds are we looking at for the end of the year?
Yeah, I mean, I do think that this continues. I think it'll be fueled by European factors and global factors. And I think that some of the sort of background risks that people have in mind that are maybe continuing to weigh on yields will dissipate, and those are largely global risks, to be honest with you. I'm still talking about 0 for 10-year bunds for the end of the year. That, as anyone who was listening to us earlier in the year, that's a little bit of a downgrade, because obviously we rallied very strongly over the summer, and I mean, to call for a much higher level than that, I think these sorts of levels of volatility would be sort of overplaying your hand. But I think that the direction of travel very much still upwards in yield.
Nice to be doing a podcast where they're going in the right direction for once. Well, I know they have been for the last couple of weeks, but I missed out on doing the pod for those weeks. And over the summer, it felt like we were always doing the pod when they were going the wrong way. So suddenly 0% doesn't seem so far off in 10-year yields. I just wanted to pick up on something that you said earlier then about kind of upgrades to outlooks and things like that, and just quickly ask about Sintra, because obviously that was the kind of main event in the euro area, or one of the kind of risk events that we were thinking about at the beginning of the summer. And Lagarde's opening remarks yesterday, we're recording this on Wednesday, so yesterday, what did you think about them? Was there any kind of fireworks, any key takeaways, or was it really just sort of business as usual and come back in December?
Fireworks there were not. From Lagarde in particular. I mean, to be honest with you, she's a little bit more aloof than Draghi was. She rarely is the one that you would particularly look for to give a strong message about in terms of any difference direction that the ECB might be taking. Nonetheless, we've had a big sell-off in rates, and it's relatively soon after they changed their guidance about what they were going to do with QE, with this moderate slowing in the pace of QE, which, by the way, we actually haven't particularly seen in the data, but that's a different story. So it might have been a reasonable opportunity for her to just refine the message a little bit, and if she wanted to just say, listen, we're not very happy with the level of volatility that we see in markets at the moment. That's a message that we've heard before from the ECB. It wouldn't have been completely outlandish to expect that, but she didn't at all. Essentially, all we got from her was, we're broadly satisfied with the way that things are going. I mean, reading between the lines, rates should be a little bit higher. It's all kind of attuned with fundamentals. They quite like inflation expectations in the markets continuing to rise, and so on. So no real effort to push back on what we've been seeing at all from her. And as for the rest of the conference, all I can say is that I have an inordinate amount of reading, as do you.
Great. I look forward to that. All right then, Dan, over to you in the US, where I guess, well, the focus has always been on monetary policy, but there's been a little bit more focus in recent days and weeks on the fiscal side and the political headlines. So could you just update us on where we stand on that and what's going on in Congress at the moment and what's our take on all of that?
Sure, yeah. It really has been a jam-packed week with headlines back and forth. But I think for the near term and perhaps this week, we're recording this on Wednesday. So by the time this is released, we might even have a couple more developments. But for politics, really there's three pillars that are around this fiscal dynamics in Congress. The first being the bipartisan infrastructure bill. And I'm starting with that because that, in theory, should be the easiest one to get through. It has already passed the House. It has already passed the Senate. And it pretty much is ready to pass the House. But the thing is, the progressive side of the Democratic Party wants to hold it back a little bit in order to get the partisan, Democratic only reconciliation bill, which would have a lot more of social infrastructure spending in it. The number touted is about $3.5 trillion. But the vote for the bipartisan bill was scheduled for Monday. Now it got pushed back to Thursday, and who knows, maybe it gets pushed back again to next week. Because there's a faction in the Democrats that have all this leverage and they're using it right now. Our base case for that is that it will eventually either pass this week or if not shortly after, and it will become a law. Remember that like I said, it has already passed the Senate, so there's no going back and getting it carved up again. And the fiscal impact of that is like $550 billion of new spending spread over multiple years. So it shouldn't be really too heavy as far as financing goes. I mean, the Treasury itself is so overfunded with the current rate of coupon issuance, which will update listeners and readers in due time before the November refunding. But so that's number one. Number two is the Democratic only, the larger infrastructure bill, which is supposed to go through the reconciliation package, but it is really a tough one. It has been causing a lot of rifts within the Democratic Party. The bill itself isn't really finished. Honestly, there's this framework for how to pay for it is yet to be released. And as a reminder to our listeners, the initial size of the package was touted to be something around $3.5 trillion. So if this gets the Senate, which unlike the other bill, it hasn't passed the Senate yet, it is likely to get stripped apart there. We think if it manages to get through Senate, it will be probably about half its size, something like $2 trillion. Once the Senate's done with it. So we expect that one to pass as well, but this is not this week's issue. It seems like it's going to be later on this year. However, our base case was something like $2 trillion of spending with $1.5 trillion of pay-fors, tax increases, and so on. And finally, the one that we have been focusing a lot more on is the government funding / the debt ceiling issue. Two separate problems. The government funding is due this week because if Congress doesn't pass a bill this week, government will go into a shutdown. The bill that the House sent to Senate included the so-called stopgap bill, included language on the debt ceiling suspension as well. As expected, Republicans shot that down. They seem to be pretty united in giving this kind of advantage to the Democratic Party. To be able to suspend the debt ceiling as opposed to just raise it by a specific number. And we have seen a lot of back and forth on that. This has been the issue where there's a ton of divide. But we do think we're going to get like a stopgap bill now that's going to get sent back without the debt ceiling language, get past the so-called continuing resolution, passes without a problem, and we will avert a shutdown. That seems to be tomorrow's business, so Thursday's business. When at the time of recording, we don't know the outlook, but it seems likely to be the modal case should happen as planned. And finally, the debt ceiling. That is an issue where we're pushing to the last minutes. Treasury Secretary Yellen sent a letter to Congress saying that Treasury has, by their estimates, about 18th of October before they default. Understandable pessimism by the Treasury. Really, they want to force some urgency, and Democrats, want to hold off to see if they can get a suspension as opposed to a raising. As a reminder, suspension would come with a regular order. It has to go to Senate. It has to get 10 Republicans or like the 60 votes total to be suspended for a specific time period, say the end of next year. And A Democratic-only solution would be with the reconciliation process, which is 50 votes only, like a simple majority, but it requires a specific dollar amount. So you have the headlines that will scream, the Democrats increased the national debt by 3 trillion, for example, which is not something they want, but eventually we think they will have to go down that path because it's better than it's better than Social Security checks not going on. And it does seem like, despite what Senator Chuck Schumer said, that's a non-starter. It looks like it will be a starter within. It seems like an early October problem again. So next week and onwards, before the 18th, which Yellen said, but it is really, it's a bit of a pickle right now.
Okay, so there really was a lot going on.
Yeah.
Thank you for that. I'm glad you're covering that and not me. So it sounds like there's a fair amount to kind of keep monitoring over the next few weeks, and I'm sure something that we will discuss next week as well. So changing gear a little bit and just flipping back to the monetary policy side, we've obviously had the Fed meeting the other week, and now we've had a fairly decent amount of Fed speakers scheduled this week. Have we learned anything new from those Fed speakers so far, or no real change from the message from last week?
So there have been a lot, and I guess one of the notable standouts was Chairman Powell and Secretary Yellen speaking to the Senate Banking Committee. That was on Tuesday, and it was an interesting one, if not for the back and forth, let's say, between Senator Warren and Yellen, calling him a dangerous man, saying he's going to oppose his renomination, which is becoming more of a pressing issue for the Biden administration. They have to make a move on that. We could see him being renominated again. He seems like the kind of continuity choice as well, and Secretary Yellen is reported to have backed him. But it just shows that there are rifts within the party, and we heard from Governor Brainard this week too, who is considered to be the most likely nominee if Powell is not renominated, and she definitely was a lot more dovish, as is known to be on tapering. It seemed like the messaging we got from her was that she doesn't think the substantial progress has been as much met, so to say, compared to Powell. So we do get this feeling that if the administration decides to go with her, the Fed could have a little bit more of a dovish tilt. But other than that, all of the messages were kind of consistent from what we heard. People kind of came out saying this is where we see the dots, and just sort of reinforcing what we got from the meeting. I guess one of the sort of officials that jumped ahead was Bullard, who basically said they got to start reducing the balance sheet right after tapering. It's not really realistic at this stage, but narrative like that causes the market to overly focus on what's next, and it is one of the reasons we think the ballot has room to sort of underperform a little bit more. But like I said, the focus near term should be on politics and not so much on we can never discard Fed speakers in some sensational statements, but the October jobs number now seems to be a little less important than what it used to be compared to the pre-FOMC, and the politics headlines should dominate the next 2 weeks.
That makes sense. All right, great. Well, still loads to talk about on both fronts then over the next few weeks. Thank you all for joining me this week. I think that's probably all we've got time for. But just wanted to remind our listeners that if you liked today's episode, please hit the like button to show your appreciation and click subscribe so you can listen to the latest episodes as soon as they're available. And if you would like to pose a question to any of our Bondcasters, please email us at bondcast@natwest.com. Thanks everyone. See you next week.